It sounds crazy, but the annual Dalbar analysis again shows the stunning investment underperformance of the average equity mutual fund investor. Measured through December 31st, 2021, the 30-year compound annual return of the S&P 500 index was a respectable 10.65%. But for the average equity mutual fund investor, it was only 7.13%. That's about one third less return per year on average. And when that compounds over 30 years, that really adds up. Stay tuned as Roshan and Adrian tell how you can escape the pattern of the average investor and come away with better long term investment performance right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Adrian Nicholson. Today, Eric is not with us. He is at a conference this week, I believe. Is that right, Adrian?
Yeah, the podcast conference. So I'm really looking forward to hearing about the stuff he's going to learn from there.
Yeah, we'll share that with all of our listeners too. Everything that we pick up there. So Adrian and I are going to take you through what we think is a very valuable topic today, which is the importance of being a disciplined investor. I think in particular, the markets and what's going on right now, they're showing why this is so important and how this can help you going forward. What really got me thinking about this is just a few books I've been reading, and then every year since 1984, Dalbar has published a report. It's called the Quantitative Analysis of Investor Behavior, and every year they'll say, what did the average investor do versus the index, the S&P 500 index. And Adrian, I'll give you a clue, and then I'll ask you to take a guess at this. So between the 30 years, January of 1992 until December 31st of 2021, inflation was 2.36%. So a lot better than what we're seeing and hearing right now. The S&P averaged 10.65% rate of return. What do you think the average equity investor did?
So if the S&P was around 10%, I would just say, let's just go with half that, 5%.
5%. Yep, you're not too far off. It's a little bit higher. It's more like 7%. They
Yes.
released a few years ago. They released this study as well, and this was between 2000 and 2010. The best performing mutual fund was the CMG Focus Fund, and it returned 18% during that time frame. But the average investor in the fund only did 11%. So we're kind of seeing a trend here where the average investor is doing about two-thirds of what the markets are doing. And let me clarify this a little bit, just so everyone listening knows this is an apples to apples comparison. This is the average equity fund investor, right? So it's not saying, okay, you've allocated your portfolio to where you've got bonds and that answers the underperformance. The underperformance is really due to the investor and what we're going to discuss today, which you could argue is a lack of discipline or emotion taking over, that kind of thing, particularly in markets like we have right now, where the markets have been down this year, and we've had some what may turn out to be bear market rallies this year. Hopefully, we get something more sustained, but we're we're seeing things. Have you heard from people or talked to people where it seems like they're making some emotional decisions in the market, Adrian?
Yeah, especially online, it's really popular on days where there's a lot of ups and then days where there's a lot of downs. Just hard to not find people talking about the markets and saying, "Oh, should I be making adjustments now? What do I need to do?" And there's this term, they're trying to chase performance wherever it may be. So it's definitely something common when you're seeing big ups and big downs. And that's why we're going to be focusing on the importance of being disciplined in these type of environments. Can because that can really pay off in the long run.
For sure, for sure. When I think about this, there's Benjamin Graham, who's the godfather of either security analysis or value investing, depending on how you want to look at it. He spends a lot of time talking about temperament in his book, The Intelligent
Mhm,
Investor. And that's really what I'm thinking about when it comes to discipline. We've had on previous podcasts, we've talked about rules-based strategies. So you have rules to follow. So to me, when I think about why it's important to be a disciplined investor, is one, it definitely gives you comfort in times like this. When the markets are down and you look at your portfolio or you look at your investments, if you have structure behind it, it it definitely leads to comfort. It allows you to really hold through this kind of market.
mhm,
And I'm telling you how it helps. Well, what it helps you avoid doing as well is just as important. It helps you avoid making decisions based on emotion and just seeing, okay, the markets are down. I'm scared of losing money. Let's sell. That kind of thing. If you have this discipline in your investment strategy and the holdings you select, it'll really help you in times when the markets are down. And as we can see with these studies, it'll pay dividends in the future.
mhm. Yeah, I completely agree with you. And if you think about it, you can pretty much apply a discipline to anything in your daily life, whether it's work, school, your health, whatever it may be. So that's why it's just extremely important to have this as well if you're an investor, because at the end of the day, this is a really good way to help achieve some of your financial goals. And that's just really important when it comes to just the investing world. For example, some common goals people have that they invest for is retirement, education, creating generational wealth, or buying a home. So, in order for you to kind of achieve these goals, having a discipline that can help you methodically make money over time by creating or sticking to a certain strategies or rule or guideline is very beneficial and can help not only meet your goals but minimize risk and also minimize costs as well, because those are two very big features when it comes to investing.
Yeah, very true. And I think you touched briefly on a topic of importance. The strategy can be unique to everybody, right? As an investor, there are a lot of different ways you can make money in the markets. We also mention this constantly. You've got to follow the path that you feel is comfortable for you. And uh, when the markets are down, I keep going back to it just because of what we're doing now. That's another thing that'll give you comfort that, here's why I bought this stock or here's why I bought this ETF. And if it's within your comfort level, your circle of competence, your investment strategy, then you can look at it and say, well, this is a paper loss. The markets are just down right now. I can wait it out. But if
Mhm.
you're constantly jumping from one thing to the other, it will very likely lead to loss.
Yeah, and we can expand on that a little bit more and just give just a real life example to some of our listeners. When we talk about just being comfortable, let's just use risk for an example. If you're somebody that really doesn't like the ups and downs of the market and you want to understand the risk and reward aspect of investing, you might build a portfolio that's comfortable for you, that has a decent return, but doesn't really go up and down with the markets as well. And if you're somebody that's disciplined, you will stay with this strategy throughout the years and not experience all these ups and downs and just be in line with that risk. But if you're not a disciplined investor in this case, let's just say you're not really doing you're not really performing as best as you thought you could, and you hear other people just crushing it with these returns, then that will lead to you what we talked about earlier, to chase performance. Then you will move outside the risk that you're comfortable with. You might get more aggressive. Let's just say you start investing more into stocks and really piling on the risk in your portfolio. Then, when you're having a really bad day in the market and equities are down, you're going to experience a lot more discomfort. So discipline in this way can help you stay in line with the risk you're comfortable with taking without you doing something differently or drastically changing the strategy you started off with.
Excellent point. And risk is such an important thing to visit and revisit. I keep talking about this market as we're, in it now, and it's a down this year. But even when markets are up, you'll find that people will sometimes, Adrian, as you said earlier, chase performance, and they'll sometimes get out of their risk zone. So this discipline is not just something that'll help you in the down markets; it'll also help protect you in up markets and prevent you from taking on risk you're not comfortable with. I've also found with clients that their risk tolerance can change based on the market environment. So it does change over time, just as people change. Life stages are different and so on. But also, uh, I've seen it change in markets, and what I mean by that is I remember speaking to someone last year. They're not a client. They were referred to me, and they had said, "We want something with very low risk that only does 10 to 15% a year." And I responded to them, uh, I'm not aware of such an investment that does 10 to 15% a year with low risk. I did not speak to them after after that conversation because I couldn't
Yeah.
give them what they were looking for. And I imagine if I spoke to them this year, it would go a little different, that
Hmm.
conversation
Yeah.
with them.
That's what leads into kind of what the critics say about being a disciplined investor. They say that it doesn't allow for flexibility, where flexibility is good in some cases it's not. For the example that you just said, some people say, "Oh, I'm a very aggressive investor. This is going to be my strategy. I'm going to stick with it. This is something I know I'm comfortable with." And then they have that really down day since they're very aggressive. They experience ups and they experience some bad downs. And all of a sudden, they're not comfortable with that level of risk. But the definition of a disciplined investor is somebody that can stick and focus on a certain rule or a guideline. So that goes against the definition of changing that strategy you have. So the flexibility is the critique for this term of disciplined investor. What do you think about that?
Yeah, hmm, to a certain extent, I agree. Where uh, lack of flexibility, I think, makes sense when you're looking at the type of investments you want to hold. With risk, though, as I said, I do think it changes over time.
Hmm.
So I think there needs to be some level of flexibility there. Just for example, and you'll see all these general finance rules on this, but they say how much you should have in stocks versus bonds based on age. And I don't think that's the best place, but it's a place to start just because I've
Hmm.
met people that were, in their 80s and were super aggressive, and then I've met people in their 20s that were super conservative, right? So the age rules don't apply, but my point being that your risk tolerance may change over time. So and as it should, if you're in your if you're saving for your child's education, as we did an episode on a few weeks ago, and that you have a newborn, it's a different risk profile than someone who's 18 and starting college in just a few weeks,
Hmm.
right?
Yeah, that's
The
what
the
I was going to
portfolio
go
risk.
to. The goals is very
Yes.
important because goals change over time. And also, as you start investing, you're going to get closer to those goals. For example, if you're saving for retirement, and we all know there's not just one number that will solve everybody's retirement, something you have to look at annually. But as you get closer to that goal, you can put in more flexibility or moderate your risk because you're getting closer, where maybe early on you need that growth rate. You need to be a little bit more aggressive to achieve this goal. And as you're getting closer or you achieve it, then that's time where you can look at, let's just say, this discipline approach that put you in a position to get here. You could put some flexibility in there and now make the changes so you can protect yourself if there is more downside or you're going to experience some loss in your portfolio. That flexibility in this case is very beneficial as you get closer, or you can say with education or a home, as you hit that mark that you're trying to achieve, then you can reevaluate.
Yeah, and the goals, as you mentioned, those can also prove to be another source of comfort when
Mhm,
you have a down market, right? Or even vice versa in an up market. So if your goals are your guiding light, or your the lighthouse guiding your path towards retirement, when the markets are, if you're, and let's just say you're a moderate investor, right? If the markets are taking off and you're doing half of what the markets are doing, you can say, well, I'm still on track for my goals. I'm within my risk tolerance. And that may help you avoid that performance chasing. And on the
mhm,
flip side, when things are down and you look at your portfolio and you look at your goals and you think, okay, well, I've got, another 10, 20 years towards my goals. So I have time for the markets to come back. That may help you avoid selling at downtime. So I think
mhm.
those, your goals can help help you from making bad investment decisions.
Yeah, exactly. I like that example you said, the lighthouse. When I was researching, getting ready for this podcast, I kept coming to what is your why to investing? And that really, in my opinion, shapes a good, disciplined investor or some of the best investors of all time. They have a goal, or why are they investing? And that's something they always go back to. That's something that helps them on the down days or even on the up days. It instills a sense of confidence too, as well. If over time it's doing well for you and you're just really going back to this as kind of like your grounding or like your centerpiece, why you're investing. And if you don't have a why to investing, that's okay sometimes, but that's also something that can really help, like we say, manage and navigate through the ups and downs of the market, which is just extremely important. If you're somebody with a strong stomach that just doesn't care, then that's fine. But if you're somebody that's trying to get to a goal, somebody that's trying to achieve something, or you're investing to get a certain goal, that's extremely important because investing is a very long game. So having this to go back to can really help out.
Yeah, completely agree with that as well, Adrian. I think we're really on the same page with this one. That made me think of one other thing. Your portfolio can also have multiple compartments or multiple goals. So what I mean by that, I'll often do this exercise with clients where I'll say, okay, you're ahead of schedule for your retirement, right? So that's good. You need, let's just say the numbers 80% of your portfolio to live on. Now you've got this 20% extra. With that 20% extra, do you want to uh, shoot for the stars and get incredibly aggressive? Or do you want to get super conservative and you can put that under the mattress? Or do you want that part to just be the same as part of your portfolio? And that answer will really vary by individual.
Yeah, and I would be on that boat where I would want to start this. I mean, I'm a planner, so I would want to start this as early as possible, get this information as early as possible. Because if you find out you're already on track for some of your goals, you could be saving or having a risk tolerance that you don't really need or you're not comfortable with. Just having looking at this data and kind of understanding and asking these questions earlier on can lead to greater flexibility and freedom in the future, can which is really helpful that a lot of people would look forward to, just having that conversation and just being able to help with your decisions going forward.
Yep. Very, very much so. Let's talk about some of the pitfalls that cause lack of discipline with investors. And Adrian, we can just trade off with our list. The first one I've got on here that I think really applies to what's going on in the market right now is loss aversion.
Mhm,
It's people who, and this can, in this market, this can lead to people who see the markets are going down, they get scared, and then they wanna sell everything. Or this can be something where you've got an investment in your portfolio that has lost money, and there may be a better investment out there, but you don't want to sell that current investment you have because then you're taking the loss to move to the better one. So that's
mhm,
one that I think when you're making investment decisions, if you're deciding to sell in particular, what's the reason behind the sale? Is it because you don't believe in the markets, if it's like a fund or an ETF or an index, or is it because the stock you bought, the thesis has what your thesis was wrong. You thought X, Y happened, so it's time to make a sale. Those make perfect sense. But if it's purely I'm scared now, but nothing else has changed, and but the markets have gone down, that's where I think you've got to evaluate your decision and really think twice as to why you're making that change.
Yeah, that's an important one. It leads into one of the ones I have on my list is you can start incurring a lot of trading costs if you're making these reactions or emotional decisions with markets going up, you're getting back in. If it's going down, you're getting back out. You can really start chipping away at your returns just with the overall trading that you're doing in this process. So
Yeah,
that is also huge.
the trading and the trading costs, I completely agree. That reminds me of a quote that I had not seen before, but this is by Gene Fama Jr., an economist. He had said, "Your money's like a bar of soap. The more you handle it, the less you have." And
Yeah, that's a good
that
one.
lines up exactly with what you said. I thought that was a pretty good quote that I actually hadn't seen that one before.
Yeah, that's an awesome one. Thanks for sharing that with our listeners. And then I'll just go back to the one that we mentioned before and just talk about chasing performance and just using like real life examples that people probably are well aware of right now for our our audience is just you're seeing it with the meme stock. That's a big example here for chasing performance where you're seeing it online, you're seeing all these huge numbers, these stocks just like going through the roof, and then next day, like crashing, going up and down. That just causes, if you're not a disciplined investor, to start chasing these stocks. And if you get in on a wrong time, you can really experience some significant losses. And just a way that you could kind of just manage this, how maybe a disciplined investor may approach this. Going back to what you shared earlier, Roshan, you can you divide up your portfolio in a way where if you have it set for certain goals, you can allocate a certain portion of your portfolio if this lines up with your risk tolerance, with your financial situation, as a way for you to be more aggressive or look at some of these stocks that do have good upside potential. But again, this is something where you have to be very disciplined, have the certain parameters and strategies in place to protect yourself on the downside, or if you do have bad timing when you get into these certain positions. So I just want to bring that up because that's just something common you're just seeing nowadays. Just they call them these meme stocks or online, these stocks that have just, not a lot of fundamentals backing them. But when you look at their performance or how well they're doing, sometimes these people just don't care. They're just looking at the numbers at the end of the day.
Oh, there was a recent report on this that I'm looking up where a college student um, got borrowed or got investment from family to put into Bed Bath and Beyond stock. And if I remember, I'm trying to look it up. The 20-year-old borrowed $25 million, put it all in Bed Bath and Beyond, and then made $110 million in that stock. Now,
Hmm.
this to me is the perfect example of what you said. There are no fundamentals behind it. Bed Bath and Beyond has been a popular meme stock. That person got in and out at the right time, and I don't have the exact days or the exact percentages, but when that person got out, within days, the stock dropped by over 50%. Right, so
Yeah.
it spiked up between from $4 a share, or a little bit more than that, in early July, up to $23 in mid-August, and now it's back down to $10. So, like you, it's and there are not now no real fundamentals behind that. There was also at one point a few days ago in this story, they were saying suppliers may stop giving them products to sell because they were worried about their ability to pay back that money. So this is a constantly changing theme. But when you talk about no fundamentals behind it and it being, you didn't use the term, but I will, a speculative bet essentially. I think this underlines that. And the scary thing about winning on these speculative bets or gambles is that it'll make you think you can keep doing it, and the likelihood of that is probably pretty low.
Mhm.
Um, and
Yeah,
I'll just
I agree.
add one of
That's some
my
important advice you're giving me, especially the fact that I'm going to Vegas tomorrow. That's
yeah.
something that I definitely need to be aware about because you hear the stories all the time.
Yeah, yeah, you always hear the stories of people's wins. You typically don't hear the stories of the losses, whether it comes to the markets,
Yeah.
or trips to Vegas. That does remind me of one of the biases I have on my list that I'll mention, which can lead to a lack of discipline. That's recency bias. That's just believing that what happened recently is likely going to happen again. And Adrian, before I forget, you were talking about a moment ago the value of staying invested, and I'll share another interesting data point. This is a study or information from Putnam Investments, and what they have is between 2006 and 2021. So December 31st of 2006 to December 31st of 2021. Those 15 years, if you put $10,000 in the S&P 500, and Adrian, I love forcing you to make a guess, so I'm going to ask you to do that again. 10,000 in the S&P 500 in 2000 January December 31st, 2006. At the end of 2021, what do you think that 10,000 was worth?
100,000.
100,000, 45, 45,000.
45.
45,000. So here, I'm gonna give you another one to guess at. If you missed the 10 best days, so we're talking about just 10 days that you missed over a 15-year time period. What do you think that lowers your dollar value to? So you still invested 10,000, you just had terrible luck and missed the 10 best days over a 15-year time period. Instead of having 45,000, what do you think you have?
Oh, I'd say 15,000. I'd say you only made $5,000.
Oh, well, that's a great guess. It's a little higher. I say that's a great guess because I definitely wouldn't have guessed this low, but it lowers you from 45,000 down to 20,929. So a little under 21,000.
Yeah.
So it's half. And the reason I don't think I would have guessed that is because you're talking 10 days over 15 years. That's not even missing a day a year. It sounds pretty minor, but you see the impact of it is huge. Next, if you missed the 20 best days, so it was the 10 best days that dropped you from 45,682 to 20,000. If you missed the 20 best days, what's your guess there as far as return goes?
I'd say 30,000,
30, you're down to 12. So you're
down to
down to
12.
12 if you miss the 20. If you miss the 30 best days, and once again, this is over a 15-year time period. So that's essentially like being out of the market 2 days a year, right? Uh, you're losing money. You're at 8,365. So you lost a little over $1,600. Then if you miss the 40 best days, which is which is like missing 2.5 days a year roughly, you lose you're down to 5,786. So you lost a little over 40% of your investment then. So
Wow. Yeah. The timing aspect is huge.
it really is, and you had mentioned earlier about this, about just people chasing performance, being in and out of the market is, and when I was talking about selling, are you selling to avoid loss or because it's a good decision? A tough part about investing, and it's a little bit of a cliche in this space, is that when the market's down, stocks are on sale. And they'll always say the only time people don't like a sale, is when it's on stocks, right? If you go to the mall, you love a sale, you love getting something at a discount, but with stocks, the fear comes in. So we want to share this information with all of our listeners so that you can see it, understand it, and know how to react when you're going through it. Because I remember in 2009 or 2010, I was at a conference with David Einhorn, who's a famous investor, right? So he was saying that in I think it was in the fall of '08. It may have been in uh '09, but he was saying that he just left the office. Everything, it was one of those days where the markets were getting absolutely crushed, And he said he just, in order to manage his own behavior and his just sort of the shock of what was going on, he just left the office for the day. I think he said he just went for a walk outside and just kept walking. Right. So that's just a story I'd share because what I like about that is he was managing his behavior. I'm sure he was fearful with the market crashing, and then he knew that doing something was probably not the right move, so he just left. So, um, with both investing on the buy side and on the sell side, I've heard people say, you do a little bit first and you see how you feel, right? Was it in fact the right decision? Was it made out of fear uh or not? So that's just getting back to the loss aversion we talked about, and in this down market, the recency bias that I mentioned as well. Adrian, what
Mhm.
additional items do you think are worth sharing that cause people to have a lack of discipline?
So another one on my list, this is also one that we kind of like briefly touched on though, is just the emotional aspect of it, which you just discussed too. And it just brings me up, you have to have a certain mentality about it when you go in. Like for example, that person just left the office just to go on a walk and just kind of cool off. That's just one way of handling it. And obviously a big thing that he probably was able to just make that adjustment is because they have certain strategies, protections in place, and they've just been doing it so long, they have a certain sophistication about it where they're able to handle these ups and downs of it. And that's just something people really just need to consider and just see if there's going to be another down day in the future. How are they going to handle it? Well, just see how they're feeling if the market's going down for one day, and that can give you a understanding on how you would react is pretty important here.
Yeah, I completely agree with you. Knowing yourself and your reaction is
Yeah. The
is
self-control
really
too
valuable.
aspect is, like you said, valuable.
And I'm sorry, can you repeat that, Adrian? I missed that last
The
part.
self-control aspect of it is extremely important in
Yeah,
investing.
agreed. And that's where knowing yourself and being disciplined really comes into place because your discipline can then trump your emotion, right? While you're going through that. And there are a lot of these different behavioral finance uh, issues that are out there to touch on. We'll share some information in the show notes for all of our listeners to read. Let's talk about how you can manage it or handle it. How knowing this can help you. I'll start with the first one, which will be pretty basic. But if you don't have a reason, doing nothing makes a lot of sense. It's going back to the study I shared with Dalbar, where investors typically get 2/3 of the return. And when I compared it to that one mutual fund, the CM Focus Fund, you know, they could have just held that fund, right? And made an 18% a year, no cost on commission. I would think less stress in from a decision making perspective, but instead the average investor earned 11 by jumping in and out. So sometimes really doing nothing is a good one. I think this is in general, depending on what you're holding, looks pretty good. But as with any of the things we're sharing, it's each situation's different, right? Like if you had an investment thesis and it just was completely wrong, that's a situation where you should act. But I think evaluating why you're making your decision. So before you click buy or click sell, understanding why you're doing that is going to help you make the right decision.
And just reevaluating as well because it could be the right decision. It works out well for you over time, but with all strategies, they experience extended periods of underperformance. So just being able to just reevaluate it constantly, see if it's still a good fit for your situation is always just extremely important. Doing nothing definitely works out sometimes, but just again, being able to always support your strategy, looking at it, seeing what changes or how can you fine tune or adjust it. It doesn't have to be major. Sometimes it can just be small steps, which can go a long way and help boosting your overall returns on your portfolio.
Yeah, very true. That is very true. Another one that is I wouldn't call this something that you should not do completely, but it's worth considering is you probably don't want to sell equities without a good reason in a down market. Assuming your portfolio is allocated correctly, it's within your risk tolerance and you're comfortable with what you have. If you're just selling because the markets are down, probably not the best move.
Yeah, because you can just see that sometimes when everything's being sold off in the market, there's just some really good stocks out there. Maybe the company has a really positive outlook. They have a lot of market share. The fundamentals look good on it, but they're just on the same boat as everybody else. And just over time, you're going to see that. But if you're just looking at the market as a whole, sometimes it's really hard for you to make that decision or make that take. But that's kind of what you're referring to here, Roshan. Sometimes it's just finding all the best companies within a market going down can really help you on the upside and show that recovery.
Yeah, yeah, agreed, agreed. The last one that I'm going to share um, is trust your approach, right? Assuming you looked at your goals, you built a portfolio that makes sense. Just because the markets are down doesn't change your goals, doesn't mean your strategy isn't right anymore. So trust the work you've already done, trust the discipline you've already have. If you're a Philly basketball fan, you'd have heard them say trust the process over and over. And I would tell you with your investments, it's a little bit of the same.
Yeah, it can pay off in the long run. You just sometimes have to maybe your timing's just wrong, but at the end of the day, if you put in the time, the effort, the research, and you just are disciplined about it and stay focused on the set of rules you have in place, it can really smooth out the returns over time. You just gotta stomach through the down times and just again, reevaluate it, see if you just need to make any small adjustments. You don't have to make any drastic changes. And if you just trust that process, like you said, that you put in place, you can really see consistent returns.
Yeah, yeah, I completely agree with that. One other thing I thought of, I know I had said in a moment ago that was the last item, but when you're investing, and I keep going back to the stock market, but I think this really can apply to any investment, a private fund, real estate. Uh, if you've got a business and cash flow. Now, remember, if you're investing in a stock, it's not just a symbol, 3 or 4 letters on the market. You're investing in a business. And just uh, with what's going on right now in the markets and this decline that we're going through right now, if the business you've invested in is still growing, it gives you a lot of comfort to just hold on to that business because it will actually be more valuable a year from now, even though the stock might be down. And I've shared this quote many times. It applies really well. One of my favorites, but Benjamin Graham said, "In the short run, the markets are a voting machine. In the long run, it's a weighing machine." So in the short run, yes, your stock can be down, but if that company is still growing, it's becoming bigger, it's getting a greater weight, so to speak, to it. Well, when we come out on the other side of this, it will be worth it will be worth more than it was before. So a good business will continue to grow, and if that's what you've invested in, hopefully that will give you some comfort as well and help avoid making any bad decisions with the markets.
Yeah, exactly. Like you said, it could be an opportunity for you where you're just buying the company again at a discount, and you're just adding more shares to your portfolio. But then it's also important just to look on the other side of it. If this is, a company that's been doing really well for you just over time, it's important for you to maybe consider looking at just rebalancing so that company's not a big weight on your portfolio. So you're still in line with that risk tolerance that you're comfortable for. So you won't experience those ups and downs of the market. Just if that's a part of your discipline approach, again, that's also something that people really should just consider. Again, if you have a strategy that's doing really well for you, are you overweight or overexposed to a certain area? So look at just rebalancing, just readjusting that so you can just stay in line is really important.
Yeah, yeah, I agree with that. I agree with that completely as well. Um, to all of our listeners, we hope you find this helpful, especially in this difficult time in the markets, and we're encouraging you to stay disciplined, trust the approach that you've taken, and try to manage and control your emotions through this market volatility. Uh, every every time the markets had a decline, yeah, it's come out higher on the other side, which it should. Is if the economy is still growing, the market should also advance, and we're hoping that you will uh, stay the right course for you. And I put it that way because um, I don't want I don't want it to sound like I think making adjustments or anything that's not a good thing. I think you should do that. I just think you should evaluate the reasons you're doing it and make sure that they're for the right reasons. As we always say, we'll be back next week with another great episode. This has been the Retirement Lifestyle Show. Please like, subscribe, give us 5 stars, tell your friends and family about us. And thank you for listening. We'll be back next week.